Have you ever wondered why the price of gold changes almost every day? One day gold becomes expensive and the next day its price falls. But what causes these fluctuations and how do they impact India's economy? How gold rate fluctuates and its impact on the Indian economy. In today's video, we'll understand the reasons behind gold price movements and their effect on consumers, businesses, and the Indian economy. Let's get started. What determines gold prices? Gold prices are influenced by several global and domestic factors. First, international gold prices. Gold is traded globally in US dollars. If the international price of gold rises, gold becomes more expensive in India as well. Major reasons include global economic uncertainty, wars and geopolitical tensions, inflation concerns, and central bank purchases of gold. When investors become nervous about the economy, they often buy gold because it is considered a safe haven asset. Second, the dollar versus the Indian rupee. Since India imports most of its gold, exchange rates play a major role. If the Indian rupee weakens against the US dollar, gold imports become more expensive, and domestic gold prices rise. Even if international gold prices remain unchanged, a weaker rupee can increase gold prices in India. Third, demand and supply. India is one of the world's largest consumers of gold. Demand rises during weddings, festivals like Diwali and Akshaya Tritiya, and investment seasons. Higher demand often pushes prices upward. Fourth, interest rates. When interest rates are low, investors earn lower returns from fixed deposits and bonds, so more money flows into gold. When interest rates rise, investors may shift away from gold, and gold prices can face downward pressure. Why do Indians love gold? Gold is not just a metal in India. For many families, it is a symbol of wealth and security. It is gifted during weddings and festivals, and it acts as an emergency financial asset. India imports hundreds of tons of gold every year to meet this demand. Now let's look at the impact of rising gold prices on the Indian economy. On the positive side, families and investors who already own gold see the value of their assets increase. Gold ETFs, sovereign gold bonds, and gold mutual funds often benefit when prices rise. On the negative side, India imports most of its gold from other countries. When gold prices rise, import costs increase, and more foreign currency leaves the country. This can put pressure on India's trade balance. Heavy gold imports can widen India's current account deficit, affecting economic stability. More dollar demand for gold imports can weaken the Indian rupee, and a weaker rupee can make imports even more expensive. When gold becomes expensive, consumers spend more money on gold purchases, and less money may be available for other goods and services. This can affect other sectors of the economy. What happens when gold prices fall? Lower gold prices can increase jewelry demand, reduce import costs, and benefit buyers and jewelers. However, investors holding gold may see lower returns on their investments. Should you invest in gold? Experts generally suggest that gold should be part of a diversified portfolio. It can hedge against inflation, provide protection during economic uncertainty, and help with portfolio diversification. However, investing all your money in gold is usually not advisable because gold does not generate regular income like dividends or interest. In conclusion, gold prices fluctuate due to international markets, currency movements, demand and supply, and economic conditions. For India, gold is more than just an investment. It is a cultural and economic asset. While rising gold prices can increase wealth for investors, they can also raise import costs and affect the country's economy. Understanding these factors can help you make better investment and financial decisions. If you found this video useful, don't forget to like, share, and subscribe for more videos on finance, business, and the Indian economy. Thank you for watching, and I'll see you in the next video.